Welcome to Investor in the Family Radio, a podcast dedicated to helping you make better investments in less time so you can live more life. My name is Brian Bain and I'm your host. You can find more shows and other valuable content at investorinthefamily.com. Well, in today's show, we have Julian Lin with us. Julian, thanks for joining us.
Thanks for having me, Brian.
Absolutely an honor to have you on the show. And about a few weeks ago, Julian wrote an article entitled "China Has Fallen, Alibaba is a Conviction Buy" on Seeking Alpha. And it's an article that caught my attention. And Alibaba is a company that obviously has been received a lot of investor attention recently. And it's been one I've been curious about. And so I asked Julian to join me on the show, and he was kind enough to do so. And we're going to talk about Alibaba. So Julian, do you mind just kicking us off by giving kind of your brief thesis from that article about Alibaba and why it's a conviction buy?
Sure. So I actually stumbled upon Alibaba on accident. Earlier in the year, I already started kind of moving my focus onto large cap tech companies. The reason why was the S&P 500. I mean, I believe in indexing, but the multiples are clearly expanding a bit. Kind of recently, it's around like 25. I mean, I'm fine with investing in maybe like a Facebook, at a P of 25. But when it's like the S&P 500 at 25, it feels a little bit like a black box. So with those large cap tech companies like Alphabet or Facebook finally seeing their earnings catch up to a P ratio that kind of makes sense, I felt like it made a lot of sense to switch gears and start investing in that area. And the reason why this opportunity happened, that is for Facebook and Alphabet to be quite cheap finally, was because of this trade war with China. So after I had done the research on Facebook and Alphabet, I began to wonder if actually maybe there was actually even more opportunities on the other side of that trade war with China. So and the idea is like similarly with how Facebook and Alphabet don't do any business in China. And thus, I felt they were not so affected by any trade war. Alibaba is very insulated in China, at least for now. So that means that, ironically, they're also insulated somewhat from a trade war with the U.S.
But investor perception, just because it's a Chinese company, led to some level of a sell-off.
Absolutely, yes. So Alibaba, just like the Chinese market, has seen itself sell off quite a bit from its highs, about like 10%. But the idea is that maybe it's more reasonably valued than it should be due to the trade war.
Right. So let's talk about the valuation standpoint. I guess talk about the valuation, then obviously just the thesis of why you like the company in general. I mean, obviously there's a lot of different views and people have concerns about investing in companies based in China, and you can go down the list of those concerns or negatives people would say about Alibaba. I think one of the big ones is it's just a mystery to a lot of people because people feel like you can understand Amazon, but if you don't live in China, Alibaba, it's hard to learn everything second or third hand. So I guess let's start with, let me see. Well, we can get, where would you rather go? We can talk about the valuation or just your overall thesis for why you like it as an investment. Where would you like to start?
Sure. So let's start with just the business in general. Whenever I start with a business, I first look at what they do before valuation. Otherwise, I feel like valuation can sometimes bias an investor. I've been down that path a lot of times. So we can start with basically first, what does Alibaba mean? It's actually not a Chinese word. This is from a very famous children's book. I think it's called 1001 Nights. Yeah. I think everyone probably knows about it.
Arabian Nights, maybe. Yeah.
Yeah, something like that. The very famous phrase "Open Sesame." That's from that book. And Jack Ma, that's the CEO. He was very fond of this book. So he started the company in, it looks like 1999, in his garage. All right. Wow. And so everyone knows Alibaba, or anyone who knows Alibaba might know it from Jim Cramer. He famously calls it the only Chinese company he would invest in. However, for a lot of people, that's where it ends. That's where the limit of where they really know what Alibaba does. They might know that it's similar to Amazon in that it has an e-commerce business. Although quite different from Amazon is that just 2 years after they started Alibaba reached profitability. That's, wow, of course, a bit different from Amazon. So as far as what Alibaba does, so they started out with an e-commerce platform called Taobao. And of course, that's not the real way to say it, but
Sure.
this is it's a very, very important one. A lot of people are going to know about Taobao and Tmall. Taobao is basically a place where the average person could sell and buy stuff from another average person. You want to think about this very similar to what eBay or Craigslist does in America, as well as also for those Amazon shoppers, whenever you're buying something from one of those low-key, not very, very popular providers on Amazon. So it's a combination of Amazon, eBay, and Craigslist. That's what Taobao is. So it's a very, very important platform where they actually have 617 million mobile monthly active users.
Wow.
It's a very, very big thing. And besides that, they also have Tmall. This is where brand names can sell directly to the consumer. They have about 150,000 brands on it. I mean, these are just basically like, I'm just reading from their website, Dyson, sure. Zara, Clarks, 3M, Nike. And this is just where if a foreign company or a Chinese company wants to sell to the Chinese consumer, they're going to go through Tmall. If you are your own small store, sort of run like a smaller versions of like Dick's Sporting Goods or something, you're going to sell on Taobao. So that is basically what these two businesses are. And
how many brands were on there, you said?
150,000.
Wow.
Basically all the brands, right? If you
all the brands.
Sell,
yeah.
Right. So American investors were going to be very familiar with what Amazon does. Well, hopefully we all use Amazon now. So we're going to, if I say that it's like Amazon, it really is. It's very important because in order to reach the Chinese consumer, you have to post on these Alibaba platforms. And that's the reason why they have such strong strength there. So that's their core business. And that core business generated about a lot of revenues, right? It generated 8.17 billion in revenue. That's US dollars in the fiscal year 2018. And that's quite a bit. And the thing is, they're much more than just this e-commerce business. And that was what really surprised me. They also have a cloud computing business, which is very similar to what Amazon does, right? Yeah. And this cloud computing business, it's already in, I believe I said 18 different countries. But then they also have a ton of revenues in that one, about 2 billion US. And they're actually, 700 million US dollars. And the key idea is with these Chinese companies, they're a little different in regulations with American companies. American companies, we have, as we know, like the DOJ preventing them from getting too big. So it tends Alphabet, I mean, they might get big within themselves, but they're not going to get big by acquiring other things. In China, especially with the lax regulations, and we'll talk about this more with Alibaba and other tech companies, they're not the same. So Alibaba actually owns a lot of other things, including something called Youku, which is like Tudou. This is the YouTube of China. China does have several YouTubes, so that's a little that's a little weird. But this is the original. This is the most famous video streaming service from the beginning. It's currently fighting with IQ. I know you've listeners know about IQ and also Tencent Video.
Right.
But Alibaba completely owns this one. That's a subsidiary. In addition to that, they also own Ant Financial. And this is a very surprising one. Okay, so Ant Financial owns Alipay. Alipay is basically, imagine Apple Pay. This is the biggest, most important application where you go to a store, you pay with your phone. In America, that's not that popular yet. I mean, there's some places that you do that, but not that many. And it's sort of, we're still in the transition of moving from cash to credit cards, let alone credit cards to mobile payments. Right. But in China, most people do that.
They skipped all those earlier steps and went straight to it.
Yes, it's really weird to imagine that China will be kind of more advanced than us in America, but it's true. It's to the point where CNBC declared that cash is basically dead in China. Everyone uses this Alipay. And I believe it's like a debit card. There's no credit card. It just goes straight from the checking account to the payment. And they own 33% of Ant Financial. We'll talk about that in a moment. Also, in addition to that, they also own 31% in Weibo. That's WB. That's also a standalone company. This is a very interesting one. I wrote that it's like the Facebook of China. However, as I wrote in another article about Tencent, it's a little weird because the Facebook we know in America has a news feed, kind of like a profile and everything where you could go look at stuff. That's what Weibo is in China. However, people don't use it as much as WeChat at Tencent. But that's a totally different topic. So those are like the main core things that I saw at Alibaba. There's of course a lot of other ones, but that's already enough, right? You
Sure.
got Amazon, you got PayPal, you got Facebook,
eBay, Craigslist,
yes.
YouTube, right?
Yes, yeah. And this is all for like $480 billion US.
480 billion US. Okay.
Yes.
So total revenues are 480 billion. Okay.
Oh, sorry, that's the market cap.
Oh, okay, gotcha. Yeah. Okay.
So it's half the value of Amazon. I think Amazon today reached over 900 billion.
Wow. Okay, so those are all the reasons you like it as an investment. Because I mean, you look at that and you think, well, if all those companies, you basically name like half the FANG stocks are rolled up into Baba, basically, and so it only makes sense. Well, and then you add that to one of the largest population countries in the world, with one of the faster growing economies in the world, and a very tech, internet, mobile focused economy being China. It seems like, well, those all seem like a really ripe scenarios for positive opportunity, right?
Yes, exactly. Yeah.
Good. Yeah. So you see all that and you think, okay, well, why not? What else is there more to it than that? And what concerns, what walk me through next steps from there?
Yeah, absolutely. So there's a lot of positive going for Alibaba, like including we're getting all this and they're already profitable. They have about 16 billion in free cash flow last year. So that means they're trading about 30, 40 times earnings and free cash flow. So you're getting like a growth engine firing on all cylinders for an attractive valuation. All looks good. But of course, we got to talk about some of the potential risks. We got to look at it more honestly. One of the things about Alibaba, the most important, is that if you own shares in Baba, you're not actually owning Alibaba. So this is a little weird. You're owning what is called a variable interest entity, a VIE, and they have a kind of a shell company in the Cayman Islands. The idea is that in order to escape some of the Chinese regulations, the Chinese government doesn't really like foreign investors in Chinese companies. So what Alibaba did was they created a shell company in Cayman Islands, which supposedly owns contracts with Alibaba and says, we get your profits. So, and then the American investors, we own shares in that VIE. So the Chinese government thinks to themselves that, okay, this is legal supposedly because American investors own the VIE, not Alibaba.
Right.
But American investors think it's okay because they think that the VIE owns Alibaba. So there's a little bit of a contradiction there.
Right.
And that is a key potential risk because we're kind of basically at the mercy of the Chinese government to not do anything weird about that.
Right. Well, and I'm glad you explained that because that's one of the questions I was going to have, and that's one of the questions that a number of investors that I respect have critiqued is, okay, all this good thing about Alibaba is great, but technically what you own is not actually Alibaba, and that's and again, that may never be a problem, but it's just enough of a risk factor for some people to think, I'm not going to do that. It's kind of like, investing in a company in a I'd just say an at-risk nation, which is a very, very general term, but basically, you don't want to invest too much in a country when you don't know stability factor, what's going to happen a year from that or 5 years from there. And that's kind of a similar dynamic here, which is unfortunate because you see this company like, this is great, but then you think, what if it's just enough of a loophole to kind of throw a curveball.
Yeah, absolutely. And the way I think about it, it really seems unlikely that the Chinese government will do anything to damage the VIEs, because if they were to do so, I don't think any foreign investments will ever invest in a Chinese company ever again after that. That would be a big breach of faith. But I mean, it is a risk that investors should know about.
Right. That's helpful. And so again, you're actually buying an interest in a company that has an interest in Alibaba. Essentially,
yes,
a guarantee
more complicated.
Right. Okay. What else? Risk factors.
Another one is Alibaba has been in 2016. Investors may know that a very famous short seller, Jim Chanos, he went short Alibaba. He's famous for being the guy who shorted Enron. So when he shorts something, everyone pays attention. So he's basically cited accounting irregularities with Alibaba. So one of the problems is, he figures Amazon has trouble with profitability, and that's because they have a lot of costs. It seems like Alibaba was not showing the costs of their business where they're kind of shipping stuff in their financial statements. They're calling it a subsidiary, but then they're not showing those losses on their financial statements. Later on, Alibaba did do that. However, when I looked at the income statement and the cash flow statement myself, I noticed that even though they might be making like $16 billion in free cash flow, basically 100% of that gets invested back into the business, they call it acquisitions of equity investees. They also call it cash paid for business combinations. So it sounds a little fishy, right? They're kind of, okay, look, it creates a weird situation where you're like, are they putting money into their friends and then are their friends circling the money back to them? And is that how they're really generating growth? So that would be the worst case scenario, right? Where the revenue growth is being manufactured kind of by a circle scheme. But then when I looked at it, it wasn't too bad. It looked like they were really buying companies. However, at some point, it doesn't really make sense to keep funneling billions of dollars into investments every year. If an American company like Facebook or Alphabet were spending $10 billion every year doing acquisitions, I don't think investors will be very happy with that. They might be more happy than the cash hoards that they do, but it is a little weird.
Sure. Well, and I surely, like during an earnings call, an analyst or someone has probably asked about that, maybe or maybe not, and maybe they haven't gotten to get a clear answer. Do you have any idea about that?
It's definitely something that they know they should be doing differently. I believe that if Alibaba were to return more cash to shareholders, like start a dividend and also start a meaningful share buyback, they haven't really done any of those actually, then the shares will see a very quick near-time bounce simply because they are getting discounted because, while shareholders like it because of the core businesses that are very attractive, they're still kind of distrusting of the management, and they're not sure if the management is really thinking about shareholders, if they're really ever going to give cash back to shareholders.
Right. Of course, that's so. I guess that really comes back to the dynamic too of what are you actually owning, and that I guess adds another layer to that because technically, Facebook and other companies, they're not giving cash back to shareholders, but the assumption is, but they're based in the U.S. We know the regulatory bodies that are governing them, and it just operates in a world. It feels like it operates according to rules that we mostly understand. Versus with Alibaba, there's always that concern of are they going to keep playing by the rules that we understand, or are they playing by them at all right now? Which again comes back to that same core concern we've mentioned already, I guess.
Yes, absolutely. With Facebook and Alphabet, I wrote previously, I think they all should be paying some sort of dividend. They should be not hoarding. There's no reason to ever hoard so much cash. Like Facebook has 40 billion, Alphabet has 100 billion. That doesn't make any sense.
Optionality, man. Optionality. If you ever need it, it's there. But
the thing is,
right.
Sorry, with these companies, it's forgivable because I guess they're American companies. American investors are always going to have a bias against Chinese companies.
Yes.
And so while Facebook and Alphabet could get away with this kind of thing, Alibaba is not going to be able to, especially like you said, if we're owning an entity that gives you ownership of earnings in Alibaba, unless you give us back the earnings, that is shareholders, it almost feels like we're not really owning their earnings.
Right.
So yeah.
So if you're actually buying stock in a company that owns the earnings of Alibaba, but Alibaba never releases earnings, it's like you really own nothing except this future promise. But of course, some people can use a similar argument against a lot of companies that don't offer a dividend because it's like technically when you own a company, you're owning a share of future dividends. And if you never ever pay a dividend, it's kind of like, well, technically, what do I own? And again, you get price appreciation and things like that, but it raises that question. But that goes to a whole nother level in a situation like this because of the way the shell company is set up.
Exactly. It's something forgivable for an American large cap company. It's not going to be so easily forgivable for a Chinese one, simply because American investors will always be less trustful.
Right. So I guess from an investing standpoint, just trying to kind of pull the thesis together for anyone who is investing in Alibaba or considering it. I mean, first and foremost, you've got to make a decision about where you stand on those concerns. Like, are you okay? Do you care about the Cayman Islands situation? And do you care about the fact they're based in China and some of those different dynamics? How concerned are you with being able to trust management? Because if those are big concerns, then it probably doesn't make a lot of sense to buy the company. If, you think those are not a problem, I don't care, or I'm mildly concerned, then obviously you could have a small position or a larger position if you don't care at all. But I feel like you really have to, that's really the first hurdle for an investor is that. Then you can come in and say, but gosh, now that that's out of the way, this is an incredibly big conglomeration of a company with a lot of potential.
Yes, absolutely. There's definitely a leap of faith that has to be taken there. And just to add to it, and not necessarily to steer listeners in another direction, but in regards to the VIE structure, and one of the problems that happened historically was in 2011. This is before Alibaba was public, and basically the main investor there was Yahoo. Mm-hmm. The Chinese government approached Jack Ma and told him that Alipay cannot operate in China because it was owned by Alibaba, and that is owned by foreign investors. So what Jack Ma did was he was like, okay, I'll just take Alipay out of Alibaba and put it into another company called Ant Financial. And Ant Financial naturally is not owned by Alibaba. So that wasn't received very well from Yahoo when they found out that basically one of the most valuable assets in Alibaba was just taken out without their knowledge into another company. And in the end, eventually they agreed to have some of the profits be shared from Ant Financial to come back to Alibaba. And most recently this year, Alibaba exercised the options, so now they own 33% of it. But I mean, in reality, this was something that Alibaba shareholders used to own 100% of. So that was definitely something that was not a very, that was kind of a dark spot in Alibaba's history.
Right.
Hopefully Jack Ma's kind of learned from that experience. I'm sure there was reasons for what he did. On the other hand, maybe it could have been better explained, but that's definitely one of the reasons why people are very afraid of these VIE structures.
So not only are the structures a concern, not only is the Chinese government a question mark at a minimum, but there's actually a historical precedent for that concern as well that reinforces. So in 2011, Chinese government told Jack Ma, hey, Alipay cannot operate in China because it's part of Alibaba, which is owned by outside investors. And so Jack Ma just pulled Alipay out of Alibaba and put it in Ant Financial. Like it wasn't like a sale or that kind of stuff. It was just like a transfer over.
I think Yahoo viewed it like stealing.
Wow. Yeah. That is pretty significant. That's not.
Yes.
Yeah. Okay. Good to know. I was not aware of that. Okay. Good to know. So let me think. Okay. So that obviously raises the stakes in terms of those concerns. And this is interesting because, I've done recently several interviews on IQ, which obviously brings up, and they're called the Netflix, the Disney of China, and there's other companies that are called like Tencent. Well, not Tencent's like the everything of everything, but there's a lot of Chinese companies that are getting a lot of attention, but they all have a similar kind of a drag on them of this concern about but can you really trust management? What's going on? But I don't know. I'm trying to think through that here as we're talking, and I guess on one hand, again, I guess you have to decide, is that a problem for you or not? And then to make that decision and then move on. And then you look at the company, and going back to what we talked about with the company, I mean, it sounds like, the company is ignoring these risks we've mentioned here, to the trust factor from a company standpoint. are there any concerns? I mean, it sounds like the company's performing excellent on all levels, or am I missing something there?
Yeah. So the good news is the answer to this question is that the company is very strong. So similar to like an investment thesis in any of the FANG stocks. Well, I'm still skeptical on Netflix, but if talking about like Facebook, Amazon, Alphabet, the reason why these stocks are so popular is because it's as close to a sure thing as one can get, right? So you almost just know that they will keep winning in the end. So Alibaba is very similar. They don't. Amazon succeeds in America because of its large network. So very similarly, Alibaba's Taobao and Tmall, they already have that large network that it creates a very high barriers to entry. So I'm not so concerned about their business. I think the main risk is definitely from the corporate structure as well as any political risk.
In terms of valuation standpoint, like in discussions with IQ and comparing it as the Netflix of China, but in reality, it kind of operates around like half the valuation of a Netflix, and that's kind of just considered to be a just kind of like just due to the risk factor of being located in China. And my understanding is that Alibaba is similar. It runs at about, if you compare it to Amazon, it runs at about half the valuation of an Amazon. Is that accurate? And is that kind of what you've seen as well?
Well, so it's very interesting. If you say IQ trades at half the valuation of Netflix, Netflix to begin with is probably the most expensive, I believe, in my opinion, of any of the FANG stocks.
Sure.
So it's still saying it's very expensive. The thing with Alibaba is that it trades half the price of Amazon. However, it trades for only 48 times this year's earnings. So, or actually last year's earnings.
When you said half the price,
42
like,
times.
You said half the price of Amazon, but like, is that similar to saying half the valuation? Because obviously price can be confusing in terms of number of shares and all that kind of thing.
Yes, half the market cap of Amazon.
Right.
However, based on earnings, Alibaba is trading at around 42 times forward earnings. So it's kind of very similar situation with, I believe, something like Alphabet or Facebook, in which compared to Amazon, they're still seeing the same growth drivers. However, they have a PE ratio which an investor could stomach.
Wait, you said Baba is at about 42x forward earnings?
Yes, and that's free cash flow too. So that's not like anyone who looked at Netflix's cash flow statements know that even though Netflix is reporting profits, they're still guzzling cash every year, right? They're not really free cash flow positive. Alibaba, this is 42 times forward earnings, which is basically free cash flow.
In Amazon, for example, is approximately what is their valuation like that? Do you know?
So that's more complicated because Amazon spends a lot of their cash flows and put it back into research and development, or they call it technology investments or something. And so, based on their definition, they might be trading around 40, 45 times the equivalent of their earnings plus the R&D. However, some people are not going to think that R&D should be just added back to earnings.
Right. So with Baba, again, I'm just going to keep walking through the steps I think that an investor needs to think through. First of all, how do you feel about the risks and concerns regarding government and the shell company dynamic? And then you have to decide, okay, that being the case, then is the business strong? And that appears to be the one thing that I'm not sure many people really dispute. Like, the business clearly has been very successful, and there's lots of room for growth, and there's a very lots of diverse aspects of the business. So that's probably the least concerned dynamic. But then the third factor is, okay, valuation. Am I okay with the valuation? And from a valuation standpoint, it's like, well, if you're okay with Amazon's valuation, then you should probably be okay with Alibaba's. Similarly, if you're okay with a Netflix valuation, you should be okay with an IQ valuation because they're valued at a lower multiple than their American counterparts, if you want to call it that. So is that safe? Is that a fair kind of a thought process to walk through as far as whether or not this is a good investment for people?
No, absolutely. That's a really, really great way to think about it. And just adding to this, I think a lot of the reasons why Alibaba trades at such same multiples, despite having a much longer growth rate than maybe a lot of their American counterparts, is because the Alibaba is listed in New York in the NYSE, but it's not listed in Hong Kong. are in China. So the main investors buying Alibaba are American investors. American people don't use Alibaba or Taobao or Tmall or anything like that. So, I mean, we don't have any reason to buy it. Like if like Amazon Prime Day just happened, we might say, oh, I want to go buy Amazon because Prime Day looks like it did well. No one follows Chinese Single Day in America.
Right.
That's the Alibaba equivalent of Prime Day. So I believe that creates a sort of makes it sort of hidden, kind of a hidden treasure in the American markets.
Right. That makes sense. Well, you mentioned in your article that it is a conviction buy for you. So obviously the concerns we mentioned are not enough for you to avoid the company. So can you walk me briefly through those 3 steps that I mentioned and how you you navigate those in terms of the risk factor, regulatory wise, company strength, and then valuation?
Absolutely. So when thinking about the VIE structure and if I'm okay with it, the way I look at it is there's no way that China is going to invalidate the VIE structure in anything short of an apocalypse. Right? That's going to be the worst case situation. So that in my opinion, avoiding Alibaba because of that will be similar to avoiding buying the S&P 500 because you think 2008 will happen again. It's just not something that I believe is very possible, is very, very likely, even though it is. Anything's possible, right?
Sure.
In terms of the company, once I understood what they owned and what they do and exactly how important it is to those Chinese citizens, I have full confidence that the businesses are very, very strong and they have a very strong outlook. And so what follows with valuation is you just got to make sure you're not paying too much. And in this case, when you're paying 42 times forward earnings for something that's growing revenue at literally 50%. Okay, revenue is growing 50% annually for Alibaba, right? So it's very, very cheap. And incidentally, I'm actually not invested directly in Alibaba. I'm actually invested in something called Alibaba. That's the ticker symbol AABA, very similar to BABA. Alibaba is what used to be of Yahoo. And basically Yahoo very famously did not do so well, right? And it turned out that their tiny investment in Alibaba has become more valuable than their core Yahoo business, which they sold to Verizon for several $billion. So what's left of it is basically it's a shell company which owns Alibaba stock as well as some other stuff, including Yahoo Japan. And the managers at Alibaba, their main focus is making sure that their discount to net asset value, basically the sum of their Alibaba stock and Yahoo Japan stock, decreases. Right now it's at 25.5%. So it's trading 25% lower than the combination of their Alibaba and Yahoo Japan stock. Both of these are public companies.
So the focus for them is to keep their NAV below retail, basically, market value.
Basically, right now the discount is at 25%. They want to narrow it down to 12% in a dream situation.
Okay, interesting.
And the idea there, so if we like Alibaba, in my eyes, buying Alibaba here is a way to get Alibaba even cheaper. You're getting it at a 25% discount. So you get all the upside of Alibaba plus about 13% upside, extra upside in Alibaba.
And you avoid the Cayman dynamic, don't you?
So that's something that I thought was true. I thought that the Alibaba gets to avoid the Cayman dynamic. But when I published the Alibaba article, someone pointed out that even though Alibaba owns, they call it the original shares, they're owning the shares before the IPO, it's still considered the Cayman stock. So I believe they still own that Cayman stock.
Okay.
So unfortunately, that doesn't let you avoid that problem.
So basically, the main reason you are investing in Alibaba as opposed to Baba is just because you can get it at a discount, which makes sense.
Exactly.
Okay. Awesome. Well, Julian, this has been a lot of fun. Is there any details about Alibaba that you want to share with us that we've missed so far? Obviously, you could talk for a long time, but anything crucial?
I think that's mainly it. I think, as you said, the most important thing is first to judge how you feel about the political and corporate structure risk related to the VIEs. because you're really not owning Alibaba. You're owning something that says you own the earnings of Alibaba. Then after that, you want to try to understand the exact companies within Alibaba. And it's going to be hard for an American investor who's never really used any of the products. So, but doing some research, you could figure out exactly how valuable those companies are. Then after that, looking at the valuation. And I mean, of course, your analysis of the companies is going to drive whether or not you think the valuation is cheap or expensive.
Of course, for sure. No doubt. Well, hey, Julian, hey, man, thanks for your great work on Seeking Alpha and sharing it with all of us. And thanks so much for joining us on the show here today.
Thanks, Brian, for having me.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.